Right, how's it guys? This is just a quick video just to introduce consumable stores on hand to all of you. Okay, you'll see here, gents, consumable stores consists of items such as wrapping materials, packing materials, boxes, and strings. Okay, such items are regarded as expenses at the time of purchase and are expected to be consumed or used up during the course of the counting period. However, in most cases, some of these items may not be fully utilized during the financial year. These unused items cannot be treated as expenses, but must rather be referred to as assets. Again, gents, here, the matching principle applies. So here, the expense must be matched to the correct time period. So you'll see now in the next example exercise exactly what's taking place. So you'll see consumable stores is given to us here in this pre-adjustment trial balance amounting to 4,500 Rand. So that figure is what you think you've used up in that expense for that particular financial period. If you then read the actual information here, the adjustment, where there's an actual physical count of consumables that's taken place at the end of the financial year, you will then see that what that reveals is there's actually 800 Rand left. So there's 800 Rands worth of consumable stores left in stock. Okay, so that's actually what's left over. That is the amount, 800 Rand, that's not been used in that particular financial period. Okay, so you can see already by having a look at this from an expense perspective that the actual expense for this consumable stores for that year is not 4,500 Rand. You actually have to deduct 800 Rand of that because that's what's left over. It hasn't been used yet. So the actual consumable stores expense should be 3,700 Rand and not 4,500 Rand. And to be able to do that adjustment, you create a new asset account called consumable stores on hand. So if we just take it through to the general journal, remember every adjustment has to be done in the general journal, and then from the general journal, we update the actual general ledger. So you'll see that new account, guys, consumable stores on hand is now an asset. So that 800 Rands worth of consumable stores that's left over now gets transferred into a new asset account called consumable stores on hand. And you can see what's happened to consumable stores. It's an expense, and we have to remove that 800 Rand out of that expense. And that's why consumable stores has been credited. So if we look at that effect in the T accounts again, consumable stores has been, we're taking 800 Rand out of consumable stores. That's why we're crediting consumable stores. And then the actual asset account, the new asset, consumable stores on hand, will be debited by that amount of 800 Rand. So if we now look at how we record this in the general ledger, we'll do it as follows. The consumable stores expense account, guys, it had a balance of 4,500 Rand that was given to us in our pre-adjustment trial balance. We now know from the adjustment that we need to reduce consumable stores by 800 Rand. And that 800 Rand, you can see we've credited the account here, consumable stores, and then we must have an equal debit. And we've created that consumable stores on hand account, which is an asset. And that's where that debit entry would be for that 800 Rand. Okay, the effect on the accounting equation, guys, you can see what's happening here. Our asset is getting bigger, so consumable stores on hand. The new asset is increasing by 800 Rand. And then what's happened to the expense is we've made the expense get less. And that decreasing expense is obviously going to improve our profit in the business. And that's why you can see that under owner's equity, that decreasing expense is shown as plus 800 Rand. All right, gents, so I'm hoping that will give you guys a little bit of an understanding there of consumable stores on hand.